The three-digit number that controls your entire life, your house, your car, your job, is not a measure of your financial health. It is the digital equivalent of a Roman slave collar. In ancient Rome, debt wasn't a score. Under the laws of the 12 tables, if you couldn't pay, your creditors had the legal right to cut your body into pieces and divide the parts among them. Physical ownership of the debtor by the creditor. Today, the brutality is invisible, but the trap is identical. The chains are no longer made of iron. They're made of algorithms. You do everything right. You pay off your auto loan early to save on interest. You celebrate being debt-free. Then your phone buzzes. A notification from your banking app says your credit score just dropped. You stare at the screen. You didn't miss a payment. You didn't file for bankruptcy. You didn't max out a card. You lost points because you lost credit mix. You closed an account, which reduced your average age of credit. This is the moment the illusion breaks. You realize the system isn't grading your financial responsibility. It's grading your obedience to the banking industry. Drop a comment if your score ever dropped after paying something off. Most people think they did something wrong. They didn't. The system punishes you for becoming financially healthy. And it does this because of a deal made in a back room 36 years ago that turned your reputation into a commodity. To understand why, you have to look at the chaos that existed before the score. Throughout the 1960s and 70s, there was no central number. Data companies quietly collected physical files on Americans, tracking not just bills, but rumors about your drinking habits, your marriage, your politics. The FBI and Treasury visited bureau offices to fill gaps in government dossiers. Invasive, unregulated chaos. Then in 1989, a company called Fair, Isaac and Company, now known as FICO, partnered with the major credit bureaus to launch the standardized credit score. It was sold as a solution to the bias. Overnight, your reputation became a number. You were no longer a person with a story. You were a risk metric to be managed. But here's the detail that explains everything. The score didn't become law because it was a good product. It took over because the government forced it on you. In 1995, Fannie Mae and Freddie Mac, the government-backed mortgage giants, mandated the FICO score for all conforming mortgages. By 2000, 75% of all mortgage applications in America were decisioned using FICO. They didn't win through competition. The government handed a private corporation a monopoly over the American dream. And once you have a monopoly, the algorithm doesn't have to make sense. It just has to be profitable for the banks. This is why the rules feel like a trap. Zero balance on all your cards, score drops. The system penalizes no recent revolving activity. FICO's official guidance admits 0% utilization is not optimal. They prefer 1 to 10%. You're supposed to carry some debt. Direct quote from the MyFICO forum. FICO absolutely penalizes for no recent revolving activity. No recent activity translates to less predictable future behavior. Think about what less predictable actually means. A person who owes nothing and pays cash is unpredictable to a bank. They can't make money off interest. They can't bet on your default. The system isn't measuring financial health. It's measuring your profitability as a debtor. Person A, $50,000 in debt, auto loans, student loans, credit cards, makes minimum payments on time, high score. Person B, $500,000 in savings, owns their car outright, pays cash for everything, no debt, low score, or no score at all. The algorithm rewards debt. But the companies entering the data are even worse. Let's say you find a mistake. Statistically, you will. The FTC found 26% of consumers had potentially material errors, 1 in 4 Americans. Consumer Reports in 2021 found 47% discovered mistakes. So you try to dispute it. You think you're arguing with a government agency. You aren't. You're arguing with a railroad company, a defense contractor, and 2 grocers. TransUnion was created in 1968 as a holding company for Union Tank Car Company, railroad equipment. They bought the Credit Bureau of Cook County, 3.6 million files, just to diversify assets. Equifax was founded by 2 Atlanta grocers in 1899. By the 1970s, the company was so hated for surveillance that they rebranded just to escape their own reputation. In 2017, they exposed the data of 147 million Americans. Consumers got $5 to $20. The CEO got a $20 million bonus. Experian's American operations emerged from TRW Information Services, a defense contractor, a grocery chain, a railroad company, a defense contractor. These are the 3 corporations that determine whether you can buy a house. If you've ever tried to dispute an error with them, you already know how that ends. But you can't fire them. You can't opt out, because the punishment for leaving the system is worse than committing a felony. Imagine 2 drivers in the same city. Driver A commits a hit and run, flees the scene, criminal conviction. Driver B has a perfect driving record, no accidents, no tickets. But they lost their job recently and their credit score tanked. The driver with poor credit pays more for insurance than the driver who fled a crime scene. Poor credit increases premiums by 109% on average, $1,400 more per year. In extreme cases, 273% more. A hit and run only increases premiums by about $2,000. 95% of auto insurers use credit scores. Only 4 states ban it. They know you need a car to get to work. They know you have no choice, so they squeeze. But it gets worse. The trap extends to employment. You need a job to fix your credit, but 51% of employers run credit checks. 1 in 10 unemployed Americans has been denied a job due to credit. Think about that loop. You lose your job, you miss a payment, your score drops. You apply for a new job, they check your score. They deny you, you stay unemployed, your score drops further. Multiple studies confirm there's no evidence credit predicts job performance. The practice continues anyway. States that ban employment credit checks see job finding rates rise by 28%. Housing. Landlords check credit for rentals. 12% of Gen Z have been denied an apartment lease. Mortgage denials are at the highest rate since 2015. 42% of Americans were denied a financial product due to credit in the past year. The monopoly knows you're trapped, so they squeeze harder. FICO raised prices by 25% in 2018, another 25% in 2019. Senator Hawley calculates a 500% total increase between 2020 and 2024. Net income nearly tripled. The CEO made $66 million in 2023. They extract wealth simply because they sit at the toll booth. It wasn't built to empower you. It was built to monetize you. We look at China's social credit system and call it dystopian. But look at what we've built. 7 million Americans are credit invisible, no record at all. 25 million more are unscored. 32 million locked out entirely. Black and Hispanic consumers, 15% invisible. White consumers, 9%. Low-income neighborhoods, 45% invisible or unscored. The Berkeley Economic Review. The core idea of a social credit system should not seem unfamiliar. In the U.S., FICO credit scores are used to evaluate prospective borrowers. The difference? China's is run by the government. Ours is run by 3 private corporations with a government-granted monopoly. The question is, which version is easier to escape? And it's about to get worse. Next-generation scoring already incorporates social media activity, smartphone patterns, shopping habits. Companies like RiskSeal track 400 digital footprints across 200 platforms. FICO is expanding. Ultra FICO links to your checking and savings. FICO Score 10 BNPL launches fall 2025. AI credit scoring, $12 billion in 2023. Projected $45 billion by 2032. First, they tracked financial data, now behavioral data, eventually total life monitoring. The credit score is 36 years old, not a fundamental law, not inevitable. 3 corporations and 1 algorithm control American economic life because the government handed them a monopoly in 1995. The system was designed to keep you in debt. It rewards borrowing, it punishes independence, and it extracts billions from the people least able to pay. Knowing how the trap works is the first step to navigating it. The history they don't teach is the history that protects you. The system was built in 1989. It can be understood, and what can be understood can be navigated. Most people learn about these systems after they've already been processed by them. History doesn't have to repeat if you study it first. Subscribe. The answers aren't hiding in the future. They're written in the past. Position accordingly.